So this is a video that I'm going to talk about the interest rate increases recently by the Bank of England, and thanks to Jesmond Kumar, who sent me a message earlier on regarding what the Bank of England has just done. So as we know, right now it's January 2022, bank base rate is 0.25, never been in anywhere near that level actually forever. I mean, I've been investing for the last 23 years, and the average Bank of England base rate has been around, in normal times, take out the last 15 years, it's probably been around 3 to 4%. Right now it's 0.25, and in January 2022 they Bank of England, I'm talking about here, they indicated that interest rate may start to go up, and in fact actually put it up. I mean, I'm talking the most marginal of increases of 0.1% on that 0.25, which according to a calculation on a £200,000 mortgage, that increase of 0.1 adds £14 on that mortgage per month. So not massive amount of increases in the mortgage per month. Nonetheless, it is an increase. But the reason why I wanted to kind of post this video is to basically give a bit more context about why they're doing this. Bearing in mind that we are in hopefully post-pandemic, we're getting out of it right now. There's a lot of spending by the government. They've borrowed billions of pounds. They've actually printed lots of money to try and get us out of this pandemic. Funding bounce back loans, funding furlough. So the country has borrowed up to the hilt. So in terms of what's happened with that money, it's either gone into the system, which is rightly so, that they try to support people not losing, not to be affected by it, businesses and the like. So, but what's happening is when you've printed all this money, that money is now slushing into the system, and it's causing a lot of inflation. And inflation is the rate at which prices go up for goods and services. So right now, the stated by the government inflation rates around 5%, but you and I know when you go to the petrol station, you pay your bills, you go and buy food at the supermarket, it's nowhere near 5%. If I had to guesstimate it, we'll probably say it's more 10%. The RPI is saying around 7.5%. So if you think the challenge that we've got now is how much money is circulating, and that's pushing prices up. And that's why the Bank of England has had to indicate that they are not going to stand back and not put interest rate up. Thus the 0.1%, a very small, and I call it signaling, is saying to people, look, we may have to increase interest rate, and if we have to, we will do it. And they've started a very low rate. The challenge I think they will have is they cannot go too far by raising interest rate for too much and for too long. So the reason why that is because the government borrowing that we've done in the billions at the moment is going to cost a lot more to pay back all the printing of money. Secondly, if you start increasing interest rates, let alone the fact that people have either lost jobs, the cost of living expenses has risen massively. Now we've got a energy crisis that's coming April onwards. They're talking about 40% increase in energy prices. That will cause absolute turmoil. So I'm pretty convinced that although there might be some signaling of interest rate rises, there will be some marginal increases over time of the 0.1% that we have seen recently. I am pretty sure that these interest rate will not be going to the level that they have been maybe say 15-20 years ago, when bank base rate used to be 3 to 5%. So why does that matter? Well, it matters because when you come to investing in properties, you really need to understand the macroeconomic factors that are affecting the rate of lending. So if the rate of lending and interest rate is going to be kept low, that means our fixed rate of interest that we will be able to access as investors should also stay at a reasonable rate. So right now I'm able to borrow under my company at just around 3%, 3.2% as an interest rate fixed for 5 years, which is pretty impressive when you think 10 years ago, the same company would have been borrowing at around maybe 15 years ago, around 6 to 7%. So that's almost half the amount that I'm paying now that I would have paid 20 years ago. So so that's why it's really important to understand these macro elements around interest rates, bank base rate of lending, because it does have an impact on us and our investment. I hope that helps. I hope that really gets you thinking about, well, what is your strategy when it comes to inflation? Are you still going to borrow? Do you fix for long periods of time? I'm very much of the ilk of, I'll buy and I will hold for the long term. So yes, I probably could, I definitely can get a cheaper rate if I fix for 2 years. But the challenge is, by the time I do 2 years and I'm buying quite a large number of units per year, that cycle of 2 years comes back really quickly, and that cycle of 2 years to renew your finances or renew your mortgages comes with cost. So as a deliberate move, I've always, whenever I buy a new property, I look to fix them for 5 years. So right now I'm fixing around the 3% mark, and I'm quite happy with that. Yes, I'm probably paying maybe about 1% over than what I should be, but over the 5-year period, I know that I'm fixed and I'm not going to have to worry about that particular property that I bought yesterday for the next 5 years. The rate of rent is going up. Actually, it's gone up significantly this year, I would say. I mean, we've done a rent roll increase across half of our portfolio in the month of January, and that's yielded quite a significant increase in our top line. So that's I would say that's why it's quite important to be able to be conversant in some of these subjects and be able to understand the effects of some of these economic factors such as inflation. Hope that helps, and if you've got any questions, please put them in the comments below and I'll be glad to answer some questions. Thank you. See you in the next one.